You've probably read about professional traders hedging their forex trades and wondered what exactly that means and how it is done. Most traders do not understand how to hedge or do not see the benefits of it and dismiss hedging altogether. Hedging with forex is a strategy used to protect one's position in a currency pair from an adverse move. It is typically a form of short-term protection when a trader is concerned about news or an event triggering volatility in the currency markets. As I said, hedging offers a short-term protection, but what it also does is that it helps you mitigate your loss or limit it to a known amount. The real benefit that I see in using hedging is that if you think a forex pair is about to decline in value, but the trend will eventually reverse, then hedging can help you reduce short-term losses while protecting your long-term profits. The first type of hedging strategy we'll be looking at is called the perfect hedge, and this occurs when you hedge the same currency pair with the same lot size. It's important to know that you should never open two positions in the same currency pair going in the opposite direction at the same time, as this defeats the purpose of a hedge. So let's look at this chart. This is a chart for GBP to USD, and let's say you're looking at this box. You're thinking the price will continue to go up, so enter a buy position, let's say here. As you can see, subsequently, the price broke out of this box. Many traders here would have a stop loss. You would be down maybe 50 pips. But you, knowing this strategy, could enter a sell position. You would stop losing capital, and this is why many traders refer to it as stopping the bleeding, as you'll be down minus 50 pips no matter if the price goes up or down. So you have entered a sell position, but you also have a buy position here. So when the sell position, when the price goes down, let's say to a previous support level, which is here, you could exit your sell position at a profit. Let's say you're a profit at 100 pips, but your buy position is down minus 150 pips. So overall, you're still down 50 pips. But now as price retraces and comes back up, let's say to here, you're now down minus 100 pips with your buy position, but you've made 100 pips. So overall, at this position right here, you've lost nothing. And so as price continues to go back further and further up, and eventually into profit on your buy position, you've not only made money with your buy position, you also made 100 pips with your sell position. Another way to hedge is by using different currencies. The basic strategy involves selecting two currency pairs that are positively correlated, such as the pound to the US dollar and the euro to the US dollar. And how it works is you take positions on both pairs but in opposite directions. And so let's give you an example. Let's say you're shorting the euro to the US dollar and then it started to go in the opposite direction. You started losing money. You would open a long position in the pound to the US dollar. But why is this? Well, if you have a short position in the euro to the US dollar, you might have to hedge your USD exposure, and you will do this by opening a long position for the pound to the US dollar. So if the euro did fall against the dollar, your long position on the pound to the US dollar would have taken a loss, but it would be mitigated by a profit to your euro to the US dollar position. And if the US dollar fell, your hedge would offset any loss to your short position, meaning that the pound would gain money, whereas the euro, this position would lose money. But hedging with more than one currency pair brings its own types of risk. If you were to trade this example, you would obviously hedge your exposure to the dollar. However, you've opened yourself up to a short exposure on the pound and a long exposure to the euro. And the point of this strategy and the previous one of a perfect hedge is to reduce your risk. But with this one, you might make a profit, whereas with a perfect hedge, you can't make money, but you can't lose any money. But with the problem with this strategy is you have the possibility of losing money from multiple positions, which can add up. The final type of hedging we'll be looking at is hedging using options. And what this means is that a trader may hedge their positions by using option contracts or binary option contracts. It's important that you're aware that option contracts have an expiry, and that using options is a more complex way of trading, not suitable for most Forex traders, as you need to also understand option trading. When a trader creates a hedge to partially protect an existing position for an undesirable move, what this is called is an imperfect hedge, because the resulting position usually eliminates only some of the risk, and therefore only some of the potential profit associated with the trade. A currency option gives the holder the right, but not the obligation, to exchange a currency pair at a given price before a set time of expiry. Options are extremely popular hedging tools, as they give you the chance to reduce your exposure while only paying for the cost of the option, which is called the premium. So let's say you're long on the pound to the US dollar, and let's say you open your position at $1.3, but you are expecting a sharp decline and decide to hedge your risk with a put option at $1.29 with a 1 month expiry. If at the time of the expiry the price has fallen below the $1.29, you would have made a loss on your long position, but your option would be in the money and balance your exposure. And if the pound to the US dollar had risen instead, you could let your option expire and would only pay the premium. To create an imperfect hedge, a trader who has opened a long position in a currency pair can buy put option contracts to reduce downside risk, while a trader who has opened a short position in a currency pair can buy call option contracts to reduce the upside risk. The first type of imperfect hedge we'll be looking at is the imperfect downside risk hedge. First of all, it's important that you understand what a put option contract is. A put option contract gives the buyer the right, but not the obligation, to sell a currency pair at a specified price, which is the strike price, on or before a specific date, which is the expiration date, to the option seller, in exchange for the payment of an upfront premium. Let's say you are the Forex trader. You go long on the euro to the US dollar at 1.1700. You're obviously anticipating the pair to go higher, but you also may be concerned about an upcoming economic announcement, as the pair may move lower if the upcoming economic announcement turns out to be bearish. You could hedge your risk by purchasing a put option contract with a strike price somewhere below the current exchange rate, like 1.1650, and an expiration date sometime after the economic announcement. If the economic announcement comes and goes, and the euro to US dollar doesn't move lower, you can hold on to your long euro USD trade, potentially making profits as it goes higher and higher. But you would have to have paid the premium for the short-term hedge. However, if the announcement comes and goes and the euro to the US dollar starts moving lower, you shouldn't worry that much, because the put option contract puts a limit to some of the risk. Because after this put is opened, the risk is equal to the distance between the value of the pair at the time of the purchase of the option contract and the strike price of the option. So in this case, it is 50 pips plus the premium paid for the options contract. So even if the euro to US dollar dropped, let's say 300 pips to 1.1400, your maximum loss would be 50 pips plus a premium, because your put contract can be exercised at the 1.1650 strike price regardless of what the market price for the pair is at the time. Imperfect upside risk hedges. They are done with call option contracts. And call option contracts give the buyer the right but not the obligation to buy a currency pair at a strike price on or before the expiration date in exchange for the payment of an upfront premium. So, let's use the previous example. You are trading the euro to USD, but this time you're shorting it at 1.1700. Obviously, you're anticipating the pair to go lower, but you may be concerned that the currency pair may move higher if the upcoming economic announcement turns out to be bullish. You can hedge a portion of risk by buying a call option contract with a strike price above the current exchange rate, somewhere like 1.1750, and an expiration date sometime after the upcoming announcement. So, if the upcoming announcement turns out to be, well, has no effects, the euro to USD doesn't move higher, you can hold on to your short and make profits as it goes lower, and the cost for the short-term hedge equal than premium paid for the call option contract, which is lost if it expires and the price stays below the strike price, which is 1.1750. But if the economic announcement turns out to be bullish and the euro to USD starts to move higher, you shouldn't worry that much, because thanks to the call option, the risk is limited to the distance between the value of the pair, which would be 1.17 when the options were bought, and the strike price of the option, which is 1.1750. So it would be 50 pips in this instant, because that is the difference. But you must also include the premium paid for the options contract. So even if the euro to USD climbs all the way up to 1.19, the maximum risk is not more than 50 pips plus the premium, because you can exercise your call to buy the pair at the price of 1.1750 and then cover the shorts for the euro to USD, regardless of what the market price for the pair is at the time. With hedging, one of the hardest parts is breaking the hedge or closing the hedge, as there's a fine line between doing it too early and doing it on the right time, or doing it too late and the right time. But hedging is a vital tool for every successful trader, and understanding why to hedge, how to hedge, and when to hedge can greatly increase your success, while misuse of hedging can be very dangerous. Obviously, hedging strategies are often used by the more advanced trader, as they require fairly in-depth knowledge of financial markets. This is not to say you cannot hedge if you are new to trading, but it is important to understand the Forex market and create your trading plan first. Thank you for watching. I hope you enjoyed the video. You should now be able to hedge in a variety of different ways. Please do like and subscribe. And we want to perceive ourselves as winners, but successful traders are always focusing on their losses.